Hello, and welcome to episode 3 in our podcast series, Credit Without Constraints, sponsored by our friends at Spinwheel. Today's episode is about trust. And as our guest, Lamine Zarad, CEO of StellarFi, astutely observed in our conversation, credit is trust and trust is contextual. What he meant by that is that all the things that we do in lending, gathering data, building models, designing decisioning rules, are all fundamentally about finding a way to extend trust in the form of credit to people that we don't know. However, as Lamine explained to my co-host, Tomas Campos, and myself, there's more than one way to scaffold trust in lending. An alternative approach, which StellarFi is pursuing, is to treat lending not as a single game with a definitive approved decline answer at the end, but as an iterative game where everyone who is not a fraudster can get a seat at the table and an opportunity over time to earn more trust and thus more credit. It's an intriguing way to think about consumer credit product design, user acquisition, underwriting, and servicing in 2026. And I hope that you enjoyed listening to Tomas and I's conversation with Lamine as much as we enjoyed participating in it. So, without further ado, here is episode 3 of our series, Credit Without Constraints. Okay, Tomas, Lamine, thank you so much for joining me.
Yeah, absolutely. Excited to do another one.
Thanks for having me.
Absolutely. This will be fun. We are, as folks who've been listening to this series know, going to get into the weeds on all things credit data, sort of future of lending. But, Lamine, I think it would make sense in this particular case, before we do that, for you to provide a little bit of context on yourself and StellarFi, just so people kind of understand where you're coming from, what you guys do in the ecosystem. So if you could start there, that would be amazing.
Yeah, it sounds good. We have quite a bit of a story arc. So I'll start with what we are today. In essence, we are infrastructure to stand up, white label and private label cards. All right. So pretty simple, pretty straightforward, but for a very specific demographic, specific sector when it comes to credit profiles. Philosophically speaking, and I always like to lean in that direction because it's more interesting in many different ways. What we are is a way to empower platforms, be it financial institutions or brands, to make use and to discover the asset they previously didn't see. And I'll explain what that means. Our history is kind of interesting too. This is my third fintech. I built 2 neobanks in the past. Last one was called Joust, which was designed for SMBs. Got acquired by a legal tech company called Zen Business. I became head of product there, chief product officer for the time being, and redesigned that operation to go after Shopify and the service-based space by offering all kinds of different tools to these newly formed businesses. And one of the things we try to do was credit, because folks need seed capital, and we struggled. We tried our own balance sheet. We tried partnerships with other companies like Divvy and a few others, and I realized that the problem there is that the underwriting just simply doesn't exist for thin file users. At the time, we were looking at entrepreneurs, if you will, or micropreneurs, as we call them. And I brought Experian as a partnership in-house, realized that's a bigger problem than, any specific segment. And as an immigrant, I personally felt that problem historically, and I knew that, certain marginalized groups in this country have faced it. But ultimately, it's an American problem. 2/3 of the adult population have scores below 680. It's a wide spectrum. Folks are habitually late paying their bills. And we thought at the time, well, if we can help them pay their bills on time, we can help them just be financially more responsible and better at managing their money and ultimately build credit. Credit building is always an externality of the whole process that we wanted to sort of institute and implement. Yeah, we went live with a direct consumer product in 2022. We learned a lot of lessons along the way, how to manage risk, how to grow efficiently, very painful, very expensive lessons. Happy to talk about those. And then realized that, really, if we can solve our business problem, we're also solving a consumer problem. If we aligned our interest as a lender with consumers' interest as, a credit builder or someone who wants to access credit, we can create something very powerful. And then if we can use our partnerships as a distribution framework and a platform, then we can do this very efficiently. And here we are today. We, like I said, we are a sort of a white label, and I use it loosely / co-branded type experience that can be embedded really in any platform.
I've been a fan of what you've been doing for a while, and I know a little bit more of your story than probably the general audience. So kudos to everything you've been doing. I think one of the things that fascinates me, Lamine, is one of your core pitches, or maybe the core pitch is like the sort of all credit score is welcome, and really going after folks who maybe, like as you said, haven't had the access or the opportunity. Two parts to this. One is, how does that actually translate into the underwriting process that you guys use? And the second part is, what data do you use?
Great question, and certainly I'm sure you're interested, because I think there's a lot of overlap with what you guys doing. I like illustrations and metaphors. I like stories. So let me start with.
You're in the right place, sir, by the way.
Yeah. Well, good. Because first of all, life without stories is just no life at all, right? Second, I think those complex concepts are just too abstract to discuss without, kind of grounding them in something real. So the way we see credit as a space in the timeline of history is where photography and movie making was at probably late 19th century, early 20th century. Folks figured out the way to use. Yeah, absolutely. We can take pictures, and we can take really good stills of those pictures, and they look really good. And we use, silver plates and all kinds of good stuff, and curtains. And that's it, right? This is where sort of the credit profile exists. It's a snapshot in time. And then you can create a photo album if you're sophisticated and you look at, a bunch of different snapshots over time. And we thought, well, what if we can animate that? What if we can bring those things together? And if we can animate it, then we can create motion. If you can create motion, you can project a lot more accurately going forward. So this is the metaphor that we use. And so all credit scores welcome is very much built on that sort of philosophical, approach to credit management, where we are capturing so many different attributes and we're bringing them together. We're not saying, historical, conventional credit profiles that bureaus generate are bad, or that a cash flow underwriting is good. Together, put together, they create much more sort of a holistic picture. It's the album. And then you start piecing the sort of missing components in addition to those two, attribute buckets, and you create motion, right? So those components are behavioral. So effectively, you're building analytical profile on a user, to use that term, right? It is, or psychometric even, where it is like a personality test of sorts. You build a profile, it's a persona. The person is going to behave a certain kind of way, and then you can start projecting it forward, and you can start plugging in data points. And what's beautiful about our system, and I'm biased obviously, is that we developed a spectrum of credit experiences. What that means practically is that we underwrite you to two things: a spending limit, which is conventional, right, like everyone else. And then we also underwrite you to a security deposit, which is not conventional. You historically, we sort of put it in one or two buckets, either an unsecured kind of a user where, we looked at your snapshot, you're good to go, you've been making your payments on time. Here you go, sir, here's $2,000, have at it. Or you're fully secured. Either we don't know anything about you, or you have really bad things in your background. You need to put a bunch of money down, and then good luck. What we're saying is that even if we can't make sense of your profile, we're going to start you somewhere. This is why all credit scores are welcome and credit profiles are welcome. I'm going to start you with a fully secured experience, but then in real time, we're going to start piecing that picture dynamically going forward. Not only are we doing ourselves a favor and obviously our platform partners, but also the consumer now sees a path forward. And we're going to talk about this hopefully here in a minute, but the roadmap starts to sort of materialize for that user that they can follow. And we make it very transparent. And we basically saying that this is what we want to see to give you more money. Give us that without, obviously exposing all of the fraud vectors that are usually present. So let me stop here. Hopefully that makes sense.
It makes complete sense. And maybe building on that, and Tomas, I apologize, I'm going to scramble our outline and just jump around because what Lamine just said triggered a thought for me. But the idea of thinking more dynamically in terms of different product structures and different kind of levers that you can use to both approve someone for an initial product and then progress them over time. I'd be curious if you could kind of explain in a little more detail how you do that. Because when I was looking at your guys' approach and your product and kind of doing a little research, that really stood out to me as being very interesting, right? I would say one of the things that traditionally has sort of characterized sort of lending and risk management and underwriting is that like credit risk professionals tend to be very dynamic when it comes to data, modeling, attributes, things like that, but sort of weirdly static on other things like product structure and like deposits and things like that, things that are like tools in the toolbox, so to speak, when you're designing a product or designing a journey for customers. But it's almost as if a large part of the industry has sort of tied one hand behind its back in relation to using some of those tools and has maybe, to a degree, almost over-relied on the remaining tools that lean more on kind of the data and analytics side. So can you kind of talk about like why you took that approach and how that works in practice?
Yeah, I mean, I agree with you. The industry is very tribal in terms of like their alliance with certain methodology. Like we only do X, and this is the X is better than the Y. And we thought it's just it's ludicrous. Like, for example, cash flow underwriting is like the hottest thing, and it's been the hottest thing for like 10 years. And everyone keeps talking about the new way of underwriting cash flow. And there's a lot of really interesting insight in cash flow, but it's not a full profile for so many different reasons. One of them is that what's interesting, especially in this demographic, consumers who have historically been sort of labeled as underbanked are overbanked, especially in the context of U.S. Banking system. Your average sort of subprime user has 3 accounts that they use to manage their funds with. They, on average, they still stick with the big banks. Your Chase account, your Wells Fargo. We've seen that over and over again. This is where they get their direct deposit into. Then they'll have some kind of a forward-looking mid-sized bank, USAAs, Capital Ones, and so forth. And then they'll have, of course, Chimes of this world, right? Currents of this world, where they would use that account to pay bills or just to play with online. And it is notoriously difficult to use data from that sort of configuration to underwrite, have a holistic picture for cash flow underwriting. And so that's one of the biggest challenges. So you kind of have to start looking at other ways. And naturally, everyone falls back on credit reporting. Credit reporting is solid. It's been around. There's a lot of data backing its efficacy. FICO score, it's been said many times. I still believe it. Still a very good way to approximate whether someone's going to pay or not, right? Although it's outdated and it's incomplete. So when you start bringing those two pictures together, now you have something that's more holistic. And the way we see it, we're not reinventing the wheel. To get in the door, we look at both things. Once you're inside of StellarFi system, we start looking at our internal transactions, and of course, there are a ton of incentives to bring in as much data as you can to enrich the profile. And internal transactions, to us, are most interesting because credit is not necessarily. Credit is trust, right? And trust is contextual. The more context you can build around a sort of a trust profile, the more accurate that picture is, and that's what we're doing. Is we're building the context. Using available sources that are notoriously difficult to sort of bring in, like I said, multiple bank accounts, other statements, anything that you have potentially, and of course the existing credit profile, and then the sort of invaluable data asset that exists inside of the organization.
Maybe on that, just to go off of that, I mean, I was talking to someone else in the industry, and they said something that was really interesting to me. They said, all this other data is like cool, but at the end of the day, we just assume that this sort of profile of customers are just not going to pay or be delayed to pay. So the thing that they were indexing on was, if I can be the fastest to get the cash from their bank account, that's the only thing that matters. Because if I'm the fastest one to get the cash from their bank account, then I know I'll get paid, and I don't care if anybody else doesn't get paid or anything else. And I thought, one, it was interesting, and two, it's a stark difference from the approach you're taking, right? So like you actually are. You go the other way. You're like, hey, I really do care about the data. The data builds the trust, as you just said. And how do you actually, do that? So when you talk about like are you talking about the actual transactions they're using on your product today, like where they're shopping, where they're spending, things like that?
Exactly. MCC level data. We're even right now looking at potentially SKU level data as well, which I think is really interesting, although unexplored, I would say. Yeah, look, it's a great framing and great question. I think historically, some of the players figured out hacks, right? These are sort of short-sighted ways to de-risk that relationship. and sort of moving the cups really, really, really fast. And it works. It certainly does. Like the faster you can move the money, for example, instead of linking a bank account, link a debit card. And the second you have the money, well, we'll pull it via debit. And now you can't not pay us, right? Because we already have your money. Certainly works, but it's extremely short-sighted. You're still treating that user as this external actor we know nothing about, except for that moment in time, you have enough to cover that bill. What we're saying is that we're investing in that relationship. And we believe that this actor is a rational actor. And if we can align their interest with our interests, then we can really drive them toward a better behavior, right? So some form of rehabilitation. It's not naive. It's just pure math, to be honest with you. We're telling them, do you want utility? Give us what we want. We'll give you more utility. And that's how we see sort of an underwriter-borrower relationship versus, like I said, rude or crude snapshot in time and some sort of a trick or a hack that will work until it doesn't.
Yeah, I mean, building on that point, one thing that I think is fascinating about that is in terms of like engaging with the users in this, it's also interesting to me how historically we've kind of not included the customer in this process, strangely. And I know that's weird to say because like they're the ones getting the loan, they're the ones using the product, like they're very obviously front and center. But as it relates to like the risk conversation, like, hey, what are you doing? And how are those actions changing how we, the lender, think about you? And maybe how the larger ecosystem of lenders you may work with think about you. We strangely don't give a lot of insight to consumers on a lot of that stuff. We don't engage them in that conversation. And I used to work at FICO. As you said, Lamine, FICO score is a great analytic tool. But I also think in some cases, for a long time, it kind of became a crutch that everyone else in the industry leaned on in terms of like having that dialogue with their customers, right? So for a long time, it was like, oh, if you have any questions about like how you're paying this back affects your ability to get credit, whatever, here's your FICO score. Here are the 5 factors. We've all seen that circular chart that has the 5 main things that like go into your FICO score. And we just sort of give that to consumers and just kind of hope like, I'm sure you'll figure it out. What I'm seeing broadly in the industry, and I think you guys are a good example of this, is sort of a different philosophy, which is like we want to have a more like tangible, real, useful, honest conversation with our customers in an ongoing fashion where maybe we expose a little bit more data about how we think about their risk or the path that they can take to progress through the different products or options that we offer and how taking those different actions might affect their larger sort of eligibility within the credit universe. Can you kind of talk through how you think about that side of it? Because I think the consumer facing element of this oftentimes gets a little left out of the discussion.
Here's how I'm thinking about this. The way we see consumers sort of a behavioral profile along with the sort of these snapshots, be it bureau provided scores, credit reports, cash flow underwriting, and so forth. It's an asset of sorts, right? The consumer owns. It's the data that belongs to them, and we treat it like an asset. It's the way we treat that transaction is almost like an asset-based lending. If the consumer can present that asset to us, we will underwrite that particular asset and give them what they want, utility. I mean, imagine selling your property, right? It could be a house or whatever, or a plot of land, and getting an appraisal done and not being able to see what's on that appraisal to then improve that property. Perhaps you had a leaky pipe that you should have fixed right before you sold. There's a symmetry when it comes to that information. If you don't know what's on the appraisal, you're going to lose money on that transaction. Someone else is going to benefit. Here, we're aligning our interests as an underwriter and wanting your asset to be the best asset with your interest and want to present your asset in the best light. I know that begs the question for fraud vectors, and we certainly have ways to mitigate it. But generally speaking, for a rational actor who's not a fraudster, it's the best thing ever. It's like, give us what we want. Not tell us what we think we want to hear. Give us what we want. I want to see what you got, and we will underwrite it, right? So this is kind of how we treat that component in that transaction. Is that we want to see that thing. We will value this thing. We tell you what we want to see. You give it to us, and then you get the utility of credit. It's very conventional in many different ways, right? It sounds innovative, but ultimately, this is the way credit's been done for probably 1,000 years.
Yeah. Yeah.
Hey, on that end, I mean, my understanding is that there's a path that customers can take from, let's say, the silver card to the StellarFi card. Can you describe what that path looks like? And then what does a customer have to do on that journey between those cards? Like, what are the assets that they have to provide to you, as you said, to maybe go through that product catalog?
Yeah, so two questions here in one. Let's start with the path, right? This is kind of a gamified roadmap, as we call it. Although it's a gamified roadmap, we don't treat it as a soft part of the experience, right? Some fun thing and a couple of badges. It is very much a foundational part of our underwriting framework. So this roadmap is effectively what we just discussed, is that we're telling the customer, we want to see, for example, 6 months of you paying your statement balance completely, and then you earn a power up. What does that do? That aligns customer behavior, shows that they're a responsible payer with our interest as an underwriter to say, this looks great in our system. Wonderful. Good for you, right? But they're also earning interesting things along the way. Points, ways to earn more spend limit, and everything that every creditor wants to do for the consumer. We sort of like telling them how to get there in a way that's responsible and takes time, right? You really can't game that in a way a fraudster would game it. You can't just age an account for 90 days, do a couple of things, and then earn a bunch of credit and go spend. You actually have to go through these steps. And so that relationship between these three card phases, really, if you will, it's one card, right? That's one thing I want to also say. It's a one card product with three phases. And you either onboard into the sort of the lowest phase because you're very risky, and then you progress by demonstrating that you're credit worthy, or you can onboard into the middle tier or the higher tier that we call Gold and StellarFi at the moment, because you proved right out the gate that you qualify for this based on your profile. And we love that concept because it solves for a whole bunch of different things. It creates stickiness. Generates loyalty because consumer now sees that we trust them, they trust us. We give them the roadmap how to progress, and we deal with graduation risk, right, which is one of the biggest risks to secured cards and just generally subprime lending. When someone actually becomes good at managing money, they're like, c'est la vie. I'm out of here. I'm going to go get Amex Platinum. We manage for that, right? We're not necessarily like creating gated experience and hanging on to them, but we're hoping to be more competitive for many different reasons. And on top of that, if the consumer decides that, look, I'm fine with this tiny little sliver of what you gave me, and they don't want to do anything else, they can stay static in that experience. So we'll give them the flexibility and the optionality to make a decision and choice. Those tiers are really interesting in a way that they create that mobility, right? And this is what the product is designed for. It's designed for mobility versus, once again, some sort of a static experience. And not only is our underwriting, sort of dynamic, it's also the experience is dynamic as well.
Okay, so just to comment on that, and I don't even know if I have a question associated with this, but I'd love for both of you to react to this because I think it's really interesting what you just said, Lamine. We think of, I'll use game theory as the analogy. I use a lot of analogies too. So I'll use game theory as the analogy for this. So like in game theory, there's a very big difference between a single game and an iterative game, right? And in an iterative game, you play over and over and over again. And crucially, you have memory between the games, right? So I remember what happened in the last version of the game, and the last version of the game, and the last version of the game. And because I know that that's going to carry over game to game to game with similar participants, it changes my behavior and my approach to the game in pretty profound ways, right? A lot of game theorists have sort of speculated that like the rise of cooperation in human societies is because living together is an iterative game where I'm going to see my neighbor tomorrow and the day after that. And so I have to approach things not with this zero-sum mindset, but thinking more in terms of an iterative game played out over a long period of time. It strikes me, and I apologize for that diversion, but it strikes me as interesting that a lot of what we do in lending today, traditionally, is much more of a single game approach, right? And think about like the language we even use to describe it. We have something called second look underwriting. And second look underwriting is like, even the phrasing of it is, okay, you screwed up. We said no, but you have one more chance with us. But then after that, I
Final
swear,
chance.
I'm not going to work with you. Like it's a very weird phrasing that I think reveals something about the way that we approach this, which is we have a set of standards. You have one chance to meet those standards. If you don't, we might offer you a second look or a way of qualifying, but probably not. And then once it's over, it's over. And I think one really good illustration of that is even something like the way most lenders treat like adverse action notices, right? Where it's like an adverse action notice, I've always thought of as much more like, here's a roadmap you can give a customer for what they can do to get a product. Like, here's a way that you can work with us in the future, even though we can't work with you today. And yet, what do almost all lenders do? They punt on adverse action. They don't give anyone any meaningful information as a part of that. And the customer just walks away frustrated because they don't even really know why they were declined. Like it says insufficient credit data. Well, what the hell does that mean? And what do I do with that? Right. And by contrast, it strikes me that what you just described about like a gamified roadmap is much more of this idea of like constructing an iterative game where, going back to what Tomas asked you before about like all credit scores welcome, that's really another way of saying like every player is allowed a seat at this table. If you're not a fraudster, you are allowed to sit at this table and play. And then the question will be, how will we work with you over time based on how you play that game and the expectations we set for you along the way? So I guess I'm curious, and Tomas, I'd love your take on this too, but like, do you think this is kind of like an emerging idea of how product construction might change in financial services? Is this something where when you explain this concept to investors or others in the ecosystem, they look at you like you have three heads? Like, I mean, like what's the, how radical a notion is this?
Yeah, first of all, beautiful analogy, and I completely agree with you that this is very much a game theory, game that we're playing here. So the way we see it, we do see it as a sort of an emergent approach, and we treat it like an emergent technology, where adverse action is not just a map that you give them. It's a regulatorily mandated piece of paper that you have to give to someone to say, sorry, we couldn't do this. Have a great life. It's not really even a map, but there are plenty of maps out there, right? That you can go get books and you can get a counselor to help you. The way we see our approach is as a GPS to your Rand McNally's or whatever those old maps that people used to have. We don't want to give you something from 1989 that's just going to be incorrect, right? Because it was written 20, 30, 40 years ago. We want to give you something that is dynamic, that gets updated by other users in the way, say, Google Maps or Waze does, right? Where the police is camping out around the corner. So it is a GPS of sorts. And you're right. It aligns, sort of a natural intent in the players, if you will, of this particular game. So if you tell them this is what you need to do to get X, and here are the resources, here are the choices you make. You start making those choices, and it's a decision tree at the end of the day. I do think this is so elegant and simple that we'll see more and more of this approach, especially as data becomes readily available. Another angle here and another component, and I'm glad we haven't talked about AI at all, because I think every conversation now is dominated by AI. And it's just boring at this point and mind-numbing. But it is nonetheless something that we shouldn't overlook. We build a model we call Stella. And Stella is your guidance counselor, right? It's a system that helps you kind of go through the entire experience. And our big vision, we're not there yet, but the big vision is that for the card itself to be smart. As you interact with the card, when you spend at a certain merchant, or perhaps you're late on your payments, or perhaps your utilization is higher than it should be, the card proactively informs you of what's going on and where you're headed, so you can tailor that behavior, right? And we see that as frankly the future of credit card usage, right? Forget agentic AI and your agents using your card. That's certainly a part of the story, but just a human credit line interaction will become more intelligent, where it's not just a thing that you have to use as a blunt tool. So this is not a hammer. It is quite literally a machine that helps you sort of navigate. So it's part of that larger navigation framework, which I'm happy to talk about. We even jokingly saying that we're animating our company. We're going to bring the company to life, and all the processes will be part of this hive mind, right? So it's not just that tiny little component sliver of what we do. It's the entire thing, end to end.
My thought on this, and I will say I've got an interesting perspective on this across a lot of different lenders in the space. Lamine, I think, has a very refined and sophisticated approach to this. To your question, Alex, I do see that this is where it's all going and where it has to go. But it's the way Lamine is thinking about this, he's so much further ahead, because the examples, and I'll just give you what I see is sort of the path that others are probably taking. A lot of banks and lenders, what they were doing is, well, let's put this like credit score management solution out there, where it's like, oh, you can manage your credit score, you can stay on top of your credit score. And that became a way to maybe re-engage with them, maybe be there and market to that customer when you felt that they had gotten to that threshold. It's nowhere near the sophistication that Lamine's talking about, where it's like, these data points and this is sort of living underwriting model. It wasn't that. But we're seeing more and more of these lenders say, well, we got to move from just credit score management to personal financial management. So almost every lender we work with has an initiative or has a product where they're trying to help consumers manage their money, because I think that's a better way to, one, drive engagement, and two, maybe be there from the right product. But they're still not there yet. And from my perspective, they're still not there yet in really kind of taking that and really injecting that, infusing that directly into their products and the underwriting. It almost still feels like it's this other silo over here that can sit nicely by your product, but it's not really infused. And I think what Lamine is saying is where it all needs to go is it truly all comes together into the product, into the experience with the consumer. And that's what I find fascinating. But I do see, to your point, Alex, I think people recognize this game and they recognize the value. Some are just playing it a little bit smarter than others right now.
Yeah, it's fascinating. I mean, just to add on to that maybe a little bit, I mean, I think that you make a good point. Like, you can see this trend sort of coming, and we're seeing examples, I think, of this, like the fact that the FICO score has kind of become a little less of the universal standard that's the only way to answer this question, I think plays into this, right? And so I think a lot of folks in the ecosystem are finally starting to think like, what if instead of FICO being the default, don't bother me with this answer, but I want to maintain like a very light remarketing opportunity should your score trigger me to reach back out to you sort of model? It's much more thinking about like, how can this be woven into the way we engage with customers? But, and then maybe, Lamine, this is a question back to you. I think it also relates to kind of your broader strategy for growth, right? And you talked about the fact that you guys do kind of like a white label co-brand sort of model where you work with partners. I think that's the other thing that's interesting tied into a lot of this, right? Is that like credit and lending is an incredibly competitive space, right? Obviously, everybody wants to get qualified borrowers. We've seen a huge surge generally in fintech where a lot of companies are now looking at like, okay, yeah, this borrower is not qualified, but they're trending in the right direction, or they're credit invisible because they've never had credit, but we think we can get to them first. Like, there's a real like competition across, I would say, almost every part of the lending ecosystem. And, I think the challenge that you have there is that you're just going to have to spend a lot of money to acquire new customers in whatever segment you're competing in. And if you want to like realize a better return on that investment in acquiring customers, I think you have to have more of a model of like, this is our customer today, this will be our customer 5 years from now, and we've built a roadmap and an interactive set of products that tie together to get them from A to B. And so, Lamine, I'm curious, what sort of went into the pivot to focus more on kind of B2B to C and kind of going this partnership route? And how do your partners that you work with think about how this type of product construct fits into their customer acquisition and customer retention strategies?
Yeah, it's sort of a layer cake decision-making process for us. Mm-hmm. We launched as a D2C company, right? And we spent a lot of venture capital dollars on direct consumer acquisition. And frankly, there was this sort of a macro pressure of sorts to move away from it, right? VCs are like, we don't want to finance Facebook and Google. And I'm being transparent as that was the first signal for us. It's that we've got to do something else. We were lucky. It wasn't by design. As much as I'd like to take some credit for it, but we were accidentally sort of stumbled into a bunch of affiliate partnerships. When we were running our direct consumer, kind of a strategy, we said, let's diversify. Let's blanket every single channel that we can, everything from organic to paid to affiliate. And affiliate was like the sort of a really interesting set of channels where we were building relationships with brands, fintechs, FIs, and they were sending traffic to us. And we are just obsessively tracked all kinds of different, attributes, conversion rates, quality of user, repayment rates, and affiliate consistently, won. And they consistently came in second after organic traffic. Organic is the highest intent; they're always going to behave better, or they're going to be, pure fraudsters. They're sort of binary. And then, affiliate was always sort of a top channel. And so we started to talk to a lot of our affiliate partners in terms of what we can do to improve initially conversion rates. And it became clear to us that FIs and fintech platforms that do KYC and have all the PII data could simplify the process by packaging the data with consumers' permission and sending it to us. So we build this handshake API in the back end that will simplify the onboarding into StellarFi instead of the user having to fill out the form themselves. And we dug deeper and realized that what they actually wanted is a way to sell our product. And so we started to test that idea and then realized that, wow, this is doable, and it opens up this amazing asymmetry when it comes to growth with a negative CAC, which doesn't exist in consumer finance and certainly not in fintech. And so we looked at the landscape, and two things emerged. One, as you said, it is crowded, but it's crowded in a really interesting way. If you were to look at the sort of a scatter plot of all players in the space, folks that are enablers like us, your imprints, your cardless, and of course the FIs themselves, the Synchronies of this world, they're all sort of like cluster around prime user for most part, right? Your 680s and above. It's a bloodbath, right? Everyone is fighting for that particular user. They're fighting for top of wallet. They're fighting for really everything. And the margins are compressed. The rewards are driving even more cost and so forth. That's not something like you want to get into, and you're probably not going to survive. And then the subprime and near prime space is dominated by these direct consumer operators. Just don't have anything special, right? And I'm not saying that as a founder to throw shade. Frankly, these are really sort of rough products out there, and our user base will still gladly subscribes, right? Because they don't have a lot of options, and it's a massive user base. And then we thought, what's the pushback from some of our potential partners as we were chatting with them on saying, let us embed this product and you sell it? Well, the biggest fear was that we'll have a bunch of declines, right? The same way they're declining, customers for, let's say, a mortgage operation declines customers for mortgage. And this is when, it occurred to us that we really need to come up with a way to be able to serve all credit scores and all profiles. And that sort of drove the strategy, right? It was very much driven by market friction versus us being brilliant, and in a basement somewhere. That's kind of how it all came about, is that the partners were like, can you approve everyone? Is there a way to do this somehow? And then we'll sell it for you. And that was sort of the origin and the evolution of the product.
Hey, Lamine, question for you on this. How do you balance the benefits of having more of these data signals and these data attributes that help you drive your product? How do you balance the desire and the need for more data with oftentimes that friction that the user has to deal with to try and provide that to you, right? That's always something I find fascinating, because it's, too much friction prevents all the benefits. Too little data, same thing. So how did you balance that?
Bribery. That's the only way to balance it. I mean, it is a real friction point, right? And we iterate and we iterate and we iterate. And there's so many different things you can do, but all of them are sort of, they're not structural in nature, right? Like better UX and, nicer way to ask. None of that really matters. What matters to a user is the utility. When you ask them for something, you're effectively asking them to provide you with work or invest, whether it's time, effort, resources, whatever it is. So you have to reward them with real utility. And that's kind of what we are working on. This is going to be continuous work, right? How do we give you what you think you want for the things that we need? At the high level, it's elegant and it balances really nicely when we say, the more data you bring in your banking situation, the higher credit limit that you'll get, right? And it's it's logical. And they're like, okay, cool. Instead of giving you this Chime account with $10 in it, let me link an account that I actually get my my paycheck into, so I can get more from you. But in reality, it is a struggle, and you have no idea how many designs we went through and how many messaging tests that we went through. It's an ongoing struggle.
Well, we appreciate your honesty on that and other topics so far. You mentioned AI, and I want to ask about this briefly before I turn it over to Tomas for the last question. I think I agree. We've done a great job of staying away from AI in this conversation and talking more about the actual philosophy of building products in this space. But also, as you mentioned, AI is kind of the water we swim through today, and it does have great capacity for changing the dynamics in some ways that we've been talking about. You mentioned the idea of having sort of a chatbot, Stella, right? That can sort of speak to the user, and that the user can kind of get like a sense of like what to do and ask questions. And I like the vision of having sort of a credit card that kind of is more interactive and sort of tells you things as you use it. Again, the GPS analogy makes a lot of sense to me. I'm curious if we sort of zoom specifically in on like the LLM agentic AI corner of AI broadly, what are some of the unique attributes about this technology that you think would be additive to the type of experiences you're trying to create, or the processes you're trying to create for the partners that you work with?
Well, first of all, let's start with what we have and what we learned, and we can talk about like our strategy and philosophy here. So Stella is not a chatbot. We specifically veered away from building another chatbot for many reasons. One, I still don't think consumers want to interact with someone via text and say, "Hey, what's my credit score?" Yeah, I've looked at. By the way, my very first neobanking, sort of a company foray into neobanking. The idea was like to build chat-based banking, which was a disaster, right? And we were like doing that back in 2016. And I developed like serious allergic reaction to like anything to chat based. I think there's time and place for it, just not in the context of like your financial picture. People want to see everything all at once, and they want it to be tactile. They want to be push buttons. That's what we've learned. And so Stella is not a chatbot. Stella is the brain, right? It's the logic behind your experience. And your experience is still very much, sort of a dashboard experience that gets updated with messaging and gets updated with various different CTAs and prompts. And the second reasoning there, we didn't want people to reverse engineer Stella. There's I don't know if it's fake or a joke of sorts, people sharing Chipotle bot that tells you how to, code in Python, right? So we didn't want to be Chipotle bot, that's telling you how to code in Python or reverse engineer some information that wouldn't give consumers. So it's all hidden behind these rails. We want to make sure that this is your data, it's sensitive. Let's not let it go off the rails. And so there's a series of prompts that we build in the back end. It's a whole system we call the benchwork that we actually give to our partners, where they can create their own experiences, their own personalities, and their own outcomes with Stella. That's that. And this is where I see LLMs specifically within the context of AI live. LLMs are just that. They're large language models. They take a lot of information, they sort of crunch it, synthesize it into human-friendly interface and presentation. They take something that can be abstract and complex, and it can explain it in a way better than we can do it, because LLMs are sort of quote unquote are on all the time, right? They'll iterate and iterate and iterate. What I'm more excited about is some of the new developments in AI that are not LLMs. LLMs are sort of built on a transformer model. This is statistics, right? Statistics 101, which I think is our biggest limitation. I think, in generally speaking, in underwriting and credit, because statistics still have that industrial blinders on. And the problem with LLMs and transformers and anything credit related is that there's no transparency. If you talk to head of data at OpenAI, I was at one of the meetings, and he's like, "It's alien. We don't even know what it does." It's nonsense, right? It's not alien. It's just so complex. There's so many permutations that the human mind and intellect simply cannot follow it. And that's the problem, is that you don't know why it did this thing. You see the input and you see the output. While there's a new development with KNs or CANs. CANs are a potential substitute for transformers, specifically related to analyzing numerical data, and it was designed in physics initially. And now we're seeing some really interesting testing still in the scientific community as it relates to predictive analytics with non-standard data, right? So you can start building models akin to, say, credit models using CANs, and it's descriptive, because it's, instead of showing a static a point in time as a score, it's a distribution, and it's got a bunch of sort of like micro distributions within the answer, and so you can actually extract the data, show the regulator or the banking partner why the decision was made the way it was made. And it's much more efficient to operate than LLM, so it's cheaper. So this is the kind of stuff I keep track of. It's still very much in, like I said, scientific realm, quasi sci-fi still, but that's what excites me. I think we're going to see something material, and we're certainly playing with some of those models now. We'll see something more material probably in 3 to 4 years. But LLMs have their place, right? And this is what Stellar does. Stellar helps user make sense of complexity and abstractness of data, and making it more human and making it more sort of like interactive in a sense.
It's fantastic. So, final question for you. So the whole series of this podcast is around credit without constraints. So if you had a magic wand and you could eliminate a constraint that is holding back or interfering with the way that consumers access and shop for financial products, what would that constraint be that you would just want to get rid of with that magic wand?
Well, my answer, it's no mystery here. It's just the constraint is that consumers they have way too many accounts. They're sort of they're distributed. That their financial lives are so distributed and so complex that it's nearly impossible to bring them into one picture. And this is what we're trying to solve for, but it's a lengthy journey. If I can wave a magic wand today, that's what I would like to do. Of course, I would make sure that we have all the patents on it. That's if we can do this, and if we can partner with companies like yours, Tomas, to help us do it, I think it's a win.
I think we got the same vision on that one, Matt. So we can make it happen.
That is I love when the wave a magic wand question becomes a obvious and great commercial opportunity for folks to pursue. Great conversation. Thank you so much, Lamine. I was frantically taking notes as you were talking. Lots of great ideas, and appreciate you carving out some time for us.
Yeah, great stuff. Thanks, Lamine.
Yeah, my pleasure.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.